So, the 2025/26 tax year has officially kicked off, and wow, it's brought a whole wave of changes for UK small businesses. Feeling a bit overwhelmed by it all? I get it, but don't be. In the next few minutes, we're going to cut right through the noise and give you a super clear guide on what's new and, more importantly, what it all means for your bottom line. All right, let's dive straight in.
First things first, let me ask you a straight-up question. Are you really ready for this new tax year? I mean, with new rates, new thresholds, and a bunch of new rules that have been in effect since April 6th, being prepared isn't just a good idea anymore. It's absolutely essential to protect your profits and, stay compliant. So, are you ready?
Look, if you're not 100% sure where you stand, don't sweat it. You are in exactly the right place. We're going to break all of these changes down into simple, easy-to-digest steps. By the time we're done here, you'll know exactly what you need to do.
All right, let's start with the stuff that's going to hit your wallet the fastest. The cost of your team. Yep, we're talking about payroll. These are the numbers you've got to get right in your software, like right now. Okay, here's the first big headline. The rate you pay for employers' national insurance contributions, or NICs, has jumped up by 1.2 percentage points. So it's gone from 13.8% up to a nice round 15%. To put it simply, every single employee on your payroll now costs you more. This is a direct hit to your overheads, plain and simple.
And you know what? It's kind of a double whammy. It's not just that the rate is higher. You actually start paying it much, much sooner. The threshold has been absolutely slashed from over £9,000 a year down to just $5,000. This is a massive change, especially if you rely on part-time or lower-wage staff, because a bigger chunk of their earnings is now going to get hit with that 15% employer NIC.
And the pressure on payroll just keeps on coming. We've also seen increases right across the board. National living wage is up, statutory sick pay is up, and so are parental leave payments. And on top of all that, there's a whole new entitlement for neonatal care. Now look, each one on its own might seem small, but when you add it all up, the cumulative effect is a real, you can feel it, increase in the cost of employment.
Okay, deep breath. That was a lot of cost pressure, I know. But hey, it is not all doom and gloom. Let's flip the coin and look at the good news, right? There are some reliefs and stable policies designed to help you offset some of those increases.
And here it is. This is probably the single biggest piece of good news for small employers. The employment allowance, which is a direct discount on your annual national insurance bill, has more than doubled. It shot up to this number right here, a whopping £10,500.
And honestly, this change is even better than it looks. Not only has the allowance jumped from $5,000 to $10,500, but the old eligibility cap has been completely scrapped. Previously, if your NIC bill was over £100,000, you got nothing. Now, that restriction is gone, which opens up this really significant relief to a lot more growing businesses.
You know, when everything else feels like it's changing, a little bit of stability is a very welcome thing. And that's exactly what we're seeing with corporation tax. The rates are holding steady with that 19% small profits rate still in place for companies earning up to £50,000. This provides some much-needed certainty for your financial planning and profit forecasting.
And here's another part of welcome stability for you. The VAT registration threshold, it's staying put at £90,000. For any business that's growing towards this number, it means you've got a fixed, predictable target, and you can hold off on that extra administrative burden of VAT for a little bit longer.
Okay, let's zoom out a bit now. The next set of changes affects those bigger, more strategic decisions. Things like how you handle your profits, when you might sell assets, and of course, how you as an owner take money out of the business.
Now, this one is absolutely critical for anyone who's even thinking about selling their business or a major asset. The capital gains tax rate is on a very clear upward path. It's already jumped from 10% to 14%, and it's scheduled to hit 18% in April 2026. This timeline really creates a sense of urgency for planning any potential exit.
All right, let's talk about how you pay yourself. The tax-free dividend allowance is staying put at just £500. And no, that is not a typo. After years of it being cut and cut again, it's now so low that virtually any dividend you pay yourself is going to attract a tax charge. This makes that whole salary versus dividend calculation more critical than ever. And here are the rates that'll kick in for those dividends above that tiny £500 allowance. The rates themselves haven't actually changed, but again, with such a small tax-free amount, that whole salary versus dividend calculation for you as a director is just, well, it's a really important conversation to have.
This is a massive heads up for businesses with physical premises in retail, hospitality, and leisure. The business rates relief that so many have relied on has been cut, and cut hard. It's dropping from a 75% discount last year all the way down to just 40% this year. That is going to translate directly into higher property costs for a lot of people.
Now let's shift gears and look to the future. How do these tax changes affect your plans to invest in growth, in technology, and in your research and development?
So, the world of R&D tax credits has been simplified, sort of. Basically, there are now two main schemes. Most companies will use the new merged RDC scheme, which gives a cash benefit around 15 to 16 pence for every pound spent. However, if you're a loss-making R&D intensive SME, you might qualify for the more generous ERS scheme, which could give you back up to 27p in the pound. That's a huge difference.
And hey, more good news on the investment front. The annual investment allowance, or AIA, is staying at a very generous £1 million. This is such a powerful tool. It lets you write off 100% of the cost of qualifying assets like machinery, equipment, or vans against your profit in the year you buy them.
And for any investments that go beyond that £1 million limit, there's full expensing, which offers that same 100% relief with no cap. But, and you need to hear this, there is a deadline. This policy is currently set to end in March 2026. So if you're planning a major capital investment, timing it to fall before that date is absolutely critical to maximizing your tax relief.
Phew, okay, so we've covered a lot of ground. Rising costs, new reliefs, strategic deadlines. Now, let's pull it all together into a clear, actionable checklist to help you navigate the year ahead.
All right, let's boil this all down. Here are your 5 key actions. 1. Update your payroll now. 2. Make sure you are claiming that new £10,500 employment allowance. 3. Review the timing of any asset sales because of that rising capital gains tax. 4. Try to bring forward any big capital purchases before the March 2026 deadline. And 5. Get to grips with the new R&D schemes and document all your UK-based activity really well.
And that leaves us with one final thought to chew on. It's really easy to look at all these changes, especially the rising costs, and just see a threat. But what if you saw them as a trigger, an opportunity to review your costs, maximize your reliefs, plan your investments strategically, and ultimately build a smarter, more financially resilient business for the future? Definitely something to think about.